Quilter Cheviot's Markets Uncut podcast, your weekly insight into the topics and trends that we've been exploring for you here at Quilter Cheviot. Remember, so you don't miss future episodes, be sure to hit the follow button on whichever streaming platform you're listening on, or by following at #QC Weekly Comment on LinkedIn. I'm your host for today, Stephen Irwin, investment manager based out of our Belfast office. And this week, I'm pleased to be joined by Richard Carter, our head of fixed interest research, and research analyst Ghaz Saleem. Good morning to you both. Richard, let's start with the Middle East because it's difficult to begin a market discussion anywhere else at the moment. The situation remains very fluid, and despite no shortage of headlines and promises of deals, there is still a huge amount of uncertainty around where things can go from here. Maurizio, one of our equity analysts, highlighted a Wall Street Journal article last week, which was quite interesting. It suggested some Arab intelligence officials believed elements within Iran's hardline leadership may be considering a wider conflict in an attempt to increase economic and political cost to the US and its allies. Recognizing how difficult it is to separate fact from speculation, do you think there's any substance to that theory? And more importantly for investors, what are the key longer-term market risks if tensions continue to escalate or the conflict simply just drags on?
Yeah, morning, Steve. I mean, it's certainly possible. I mean, for all the damage that has been done to the Iranian military, it looks like the hardliners are pretty much in charge of the situation. They've still got plenty of leverage, so it will be interesting to see how they respond to this sort of US talk of a economic D-Day and all the rest of it, more sanctions. But Iran's been living under sanctions for a long, long time, so it's hard to see what impact it will have. But it's clear that Iran wants to make any sort of action, whether it's economic or military, as costly as possible for the states. They have kind of been doing that anyway. They've got the leverage of the Straits of Hormuz, but they've obviously got these regional actors like the Houthis, allies like the Houthis, proxies in Iraq and Hezbollah as well in Lebanon. So they've got plenty of allies in the region who can do the US a lot of damage, and maybe they'll want to go beyond that. But the bigger problem for everyone, I think, is that the US doesn't really seem to have an answer to all this and how to get out of it, which means we have elevated oil price. Inflation looks pretty sticky, and expectations continue to sort of rise, and it means interest rates probably can't come down, may have to go up. So the whole sort of situation is a bit of a mess, and you can understand markets being pretty disappointed with where we are nearly 6 months into the conflict.
Yeah, and you've just mentioned that it's the energy markets and higher inflation expectations, and then the back of that, higher interest rates seem to be the real market transmission mechanism, I suppose, for the conflict. Are those likely to remain the key areas, or is there anywhere else we should be keeping an eye on?
Yeah, those are the key ones. I mean, there's obviously it's not happening in isolation. There's other things going on with AI, and then rising bond yields for other reasons that we can come on to. Those are the main ones. I mean, I would keep an eye on second round effects on inflation. So far it's going to be energy, which is fairly obvious reaction to what's been going on. But then does that start to feed into food prices, for example? They're a big part of the basket. Actually, food prices in the UK, for example, hard as it is to believe, inflation hasn't been too bad on that, but that could change. Do you start to see wages go back up again and all the rest of it? And that causes problems for central banks. And then, what about the impact on growth as well? Because, almost that's seemed to be just forgotten about, that, the AI spend is propping growth up and more military spending, and there's nothing to worry about. But you've got areas of the world like China, for example, struggling a little bit. Economy's not doing great. You've seen recent jobs data out of the States wasn't brilliant either. And the longer this kind of whole situation goes on, it sort of eats away, I think, at US consumer confidence, and right up to the midterms, and could cause problems away from just inflation. So let's hope it all gets resolved soon.
Yeah, let's hope. Fingers crossed. Anyway, um, the persistently higher bond yields, partly on the back of this, is starting to test governments, particularly as borrowing costs move to levels that are becoming increasingly difficult to ignore. I think that the US 30-year is around a five and a quarter, and in the UK the 30-year is around 5.8. Although you can double check that. Um, Last week, the US Treasury announced plans to increase its buyback program for the longer dated bonds in an effort to support the market. Um, the market reaction was quite interesting. So initially, the long end fell about 9 basis points. But what was even more interesting was that the next session, the next market session, that 9 basis points fall had been completely reversed. So um, I suppose the key here is that how effective do you think these measures are that the government are taking to support the bond markets? And what does the initial market reaction suggest? Are the bond markets sending a message to policymakers?
So the initial response kind of made sense that, oh wow, they're going to buy more long date, they're going to buy some long date bonds. The yields drop, but unfortunately, it's kind of I think the analogy has been used by others, but a sort of sticking plaster over a gigantic wound. It's the numbers are really a drop in the ocean, and really all they're doing is effectively borrowing more money at shorter maturities and helping them sort of issue a bit less at long end. But it's not solving the main causes of it, and that is sticky inflation worries because of what's going on in the Middle East, which is entirely pretty much the US's fault anyway, or certainly they can't seem to get a way out of it. You've got the fact that early, right at the start of the year, markets were hoping and expecting interest rate cuts. Not just here but in the US. That's clearly off the cards at the moment, and interest rates may need to go up. So those two things aren't good for bonds, and then you're into the whole question, fiscal problems. I mean, the US is doing. It's not. I mean, at least in the UK, we talk about the fiscal rules, and there's always a good debate about how do you pay for things. Should we save a bit here to spend a bit more here? It is accepted by all parties that they need to, explain how they're going to pay for things and have a way of trying to get the deficit back down, even if efforts have been not very successful. In the US, it doesn't even seem to be a debate. So that might have to change. I think what Scott Bessent did basically was not enough, and it just reminded people of the problems and also made it look a little bit like they are sort of panicking or starting to get worried. So in fact, they may have made the situation worse than it already was, but they'll need to address the fundamental underlying issues if they really want to get those bond yields down. It was interesting that I think Trump, and I think there's a slightly bigger thing here, a bit more nebulous, but just and this certainly comes from the Iran war, just a sense that the US rate administration is not entirely in control of events. I mean, you've got this thing going on with the trade war in Canada. It just seemed to be pretty random scattergun kind of approach. I mean, Trump was asked about the bond market and would there be more interventions? And he said that buying bonds is one type of intervention, and another type of intervention is the military. And you just sort of, okay, you just kind of wonder really where on earth this is all heading. And unfortunately, Scott Bessent probably tried to do his best, but they're not helping the situation.
Yeah, I thought it was quite amusing. I think after the market reversed the initials, yield decrease, I think Scott came out and said, "Oh, we'll increase it even further." But there was not much of a reaction on the back of that, needless to say. And moving on, but staying on the topic of bonds, fixed income as an asset class remains an important component of portfolios, providing both income and historically diversification from equities. However, the return of higher inflation interest rates, as we've just spoken about, has led to periods where both bonds and equities have moved more closely together, reducing some of that diversification benefit. In this environment, it highlights the importance of constructing portfolios with assets that offer different return drivers rather than relying solely on equities and bonds. That brings us neatly on to the asset class we call alternatives. Gaz, thanks for joining us. This is an area you cover extensively. Perhaps a good place to start is with the basics. So, alternatives is a broad term that can mean different things to different people. Could you give us a high level overview of the asset class and explain how it differs from traditional investments such as equities and fixed income?
Sure. Thanks, Stephen. So first of all, I think it's important to point out that alternatives isn't actually one asset class. It's a term that encompasses many different asset classes and investment styles. So broadly speaking, alternative investments are those that fall outside the traditional asset class of investment styles of publicly traded equities and bonds, with the sort of main types of alternative investments including private equity, which, as the name implies, is investment in privately owned companies or buying public companies to take them private. There's private credit, which is loans made directly to companies outside of the public debt markets. We've got real assets such as real estate, think residential developments, warehouses, commercial buildings, etc. We've got infrastructure, which is investment in cash flows of essential physical assets, stuff like airports, toll roads, renewable energy, etc. So those are some of the alternative asset classes with less liquid underlyings. On the more liquid side, we've got hedge funds, which are funds which aren't benchmark driven and are generally more flexible in their investment mandates. We've got commodities, so things such as gold and oil, for example. And then we've also got more esoteric alternatives such as art, collectibles, royalties, music rights, etc., which are asset classes that QC actually doesn't typically tend to engage with. In terms of how investors can use alternatives and why they might want to use alternatives, the first obvious one that you already mentioned is diversification versus stocks and bonds. There are other reasons such as access to higher return potential opportunities, via illiquidity and complexity premia, access to unique opportunities not otherwise available in public markets at all, and then some asset classes like infrastructure and real estate, for example, can also provide income generation and a degree of inflation protection as well.
Thanks, Gaz, for explaining that so extensively. Many investors, when they hear the word alternatives, they often immediately think of hedge funds. Would you mind explaining some of the different approaches hedge funds can take and how we approach the asset class here at Quilter Cheviot?
Certainly, and again, I think the term hedge fund encompasses a very broad range of the investment styles, asset classes, and points on the risk-reward spectrum. But broadly speaking, hedge funds are usually not benchmark driven. They're able to operate with less constraints than long-only funds. They can, for example, sell securities short. They have more flexibility in the use of derivatives and leverage. In terms of investment approach, they can, again, it's a very broad types of approaches, both fundamental and technical. They can be discretionary or entirely systematic, or a combination of the two. And in addition to bond and equity markets, hedge fund can also tap into commodity and currency markets. In terms of the sort of main types of strategies, I think we can literally have a podcast dedicated to each one. But at a very high level, we have long-short equity, which is essentially stock selection. We have event-driven and merger arbitrage funds, which rely on corporate events and company mergers. There is a whole host of credit-related hedge funds, from special situations to convertible bonds. We have relative value and arbitrage strategies, which aim to sort of target mispricing of similar securities. And then we have more directional but less correlated approaches like global macro, which is essentially analysis of top-down economic trends, events in central banking policy, etc. And then we have CTAs and managed futures, which are computer-driven programs which rely on following price trends in various markets. In terms of how we utilize hedge funds, I think you've already mentioned, the sort of diversification required from equities and bonds. That's really the most basic level for why we use them. The last few years have seen traditional equity bond correlations break down, and in such environments, we have seen our hedge fund portfolios provide diversification during bond sell-offs and equally often protect capital during equity sell-offs. So those are desirable traits for diversifying sort of asset classes. In addition, we also use them to access markets, skill sets, investment styles which are outside the remit of our traditional portfolios. And we also like to use them for harvesting the market return in a more asymmetric kind of fashion. We do that by really blending a diverse mix of investment styles, and that adds resilience to our portfolios through the changing conditions of the economic cycle. Finally, I'd like to just mention that while the foundation of the hedge fund industry was offshore, here at Quilter Cheviot, we typically only use funds which are regulated by the UCITS regulatory framework, and that's arguably that arguably provides better investor protection and more frequent liquidity windows, typically daily or weekly.
Yeah, thanks, guys. There's certainly a lot there. And finally, just before I wrap things up, and I know you've already touched on this in terms of the main benefits of using parts of the alternatives market. We've spoken a lot today about inflation, uncertainty, government bond market volatility, and geopolitical risks. How do alternatives fit into portfolios in this type of environment?
So yeah, I mean, for hedge funds in particular, as I mentioned, they don't simply rely on rising markets, but they rely on dispersion, market inefficiencies, price dislocations. So when macroeconomic uncertainty increases, asset prices tend to diverge more, and that creates more potential opportunities for funds of this type. If we look back to the 2010s, we had an era of very low interest rates, quantitative easing, very subdued inflation, and that created a very challenging environment for many such funds because asset prices were heavily influenced by central bank policy. Today's world is, of course, very different with uncertain inflation, shifting interest rate expectations, fiscal concerns, tariffs, trade disruptions, politics, all the rest of it. And we've certainly seen hedge funds have a good, strong run in recent years. 2025 was actually a particularly strong year for the industry, and that's driven renewed interest in the asset class and renewed flows into the asset class. In terms of specific examples of how particular strategies can benefit, think about higher interest rates and inflation trends impacting different companies in different ways, and that creates opportunities for stock pickers and for credit funds. Improvement in the IPO activity and merger environment means that there's more to do for merger arbitrage and event-driven managers, and then a more normal centralized bank function, with potentially less Fed guidance going forward. Higher levels of government bond issuance and sort of more volatility and bond markets improves the opportunity set for fixed income arbitrageurs and also for macro funds. Finally, if you think about the sort of more protracted geopolitical shocks that we've had, like Russia, Ukraine, or Iran, etc., that can trigger sort of trending moves in currencies, commodities, bond and equity markets, and macro and trend following managers can benefit from those types of moves as well. I think probably worth highlighting clearly that expanded opportunity doesn't automatically mean better returns. The same kind of dispersion market moves that can generate alpha can also increase potential for being wrong-footed. Sudden sharp shocks can be particularly corrosive for hedge funds. As an example, we've seen macro funds struggle to navigate frequent shifts in the market sentiment with inflation and timing of interest rate cuts. So the takeaway from all of that really is that manager selection, diversification within your hedge fund portfolio, and the way that you construct your portfolio are quite key to allocating to the asset class.
Okay, well, thanks for that, Gaz. I think we'll leave it there. So thank you both, Richard and Gaz, for your time and sharing your insights. I hope you've enjoyed today's discussion. We love to hear from our listeners, so please review the show now wherever you're listening and share it on your socials and tag us at Quilter Cheviot. To make sure you don't miss future episode, tap the subscribe button. We will be back next week, and in the meantime, head over to our website at www.quiltercheviot.com, where you can read the accompanying market overview as well as subscribe to our weekly comment newsletter. You can also stay up to date with our thoughts on market news, industry insights, and our upcoming events and webinars on our website or our social media pages. Finally, if you have any questions you'd like to ask one of our experts, simply ask them via the weekly comments page on our website. We love to hear your questions. And that's it for today. So thank you, Richard and Gaz, for your time, and all of you for listening. See you next time.
This podcast is marketing material, not investment advice or research material. Investments can go up as well as down, and past performance isn't a guide to the future.